Welcome to the Nuts and Bolts of Real Estate. My name is Joe Bauer, and I'm here with my co-host Julie Clark. Julie, how you doing today?
I am doing fantastic, Joe. Had a good weekend of snowboarding with the Clarkies out there at Stevens Pass. We
Nice.
had a little rain, so it was not as quite as powdery as we would like, but yeah, just getting our hours in before we head up to Whistler here in the next month. So I'm
Hey.
excited. Yay, yay. Of course, I forgot Katie's snowboard boots somehow this weekend. So that was a joy having to waste an hour grabbing that. Only $17 though to rent snowboard boots at Stevens. So that
Not
was a good
bad.
deal. But yeah, what are you up to?
Just hanging out here in Enumclaw, doing some mountain biking mostly here because not so much snowboarding, but I am jealous. I am going to be
Yeah,
really jealous
yeah.
when you head up to Whistler.
And you guys have some sunshine over there?
Yeah, I don't know what happened. It's peeking in here, and I had to switch my computer around because it was the shadow thing, so I'll take it.
All right. That seems to be the theme today, right? We had our Joel who's with us today is out in Florida having the same problem. So let me jump into it, guys. Today we are going to cover an asset class that we haven't really talked much about in the past. And that is investing in industrial assets. And joining us today is Joel Friedland, who's an industrial syndicator out of Chicago, Illinois, and the founder of Brit Properties. So we're excited to get to know Joel. I'm always looking for syndicators to vet for myself personally, and then I just like to share that information with you guys. Number one being my criteria that one of the first few words out of their mouth is the word conservative, and the other is maybe their due diligence checklist. So I am excited to introduce you to Joel today and get to know him better myself so we can learn how a long-time industrial pro structures his deals and his business model. So welcome to the show, Joel.
Hi, Julie. Hi, Joe.
Hi, hi. So you're in Florida, huh? What are you guys doing there?
Well, we're here for a month, which is amazing. I've never done this before. I'm going to tell you something crazy. In Chicago, it's impossible to buy industrial real estate assets at a reasonable price. The market's so heated up. In 2008, right before the crash, we bought about 6 industrial buildings and then ended up paying for it because of the economic downturn. We paid too much and they were worth a lot less about a year later. So my son and I are on a road trip and we're meeting with a bunch of our investors who live here, with one of the biggest reasons being we can't find buildings to buy right now. So we're just sort of biding our time. It's really unfortunate because the market is so hot.
So hot. So industrial hasn't been hit yet or impacted by financial economic news or interest rates or that kind of thing? Or, are people just stupid because there's too much money out there and, there's all these kind of crazy, even these hedge funds that are notorious for overpaying for buildings. I don't know if they've reached the industrial asset class, but they're obviously popping their heads into everything else, even single
Well,
family residential these days.
well, e-commerce has caused a boom in industrial because every product that you order to be sent to your home comes from a warehouse, which means that Amazon and Wayfair and Target and anybody who has online sales has to have a warehouse. And also manufacturing right now is doing very well because of some political unrest in, let's talk about our relationship with China as a country and so forth. A lot of companies are doing something called reshoring, which means rather than just having products made overseas, they're opening or expanding manufacturing facilities here in the United States. So the demand for industrial is continuous. It's been great since the beginning of COVID. And for the reason that during COVID, people were ordering lots of things from home and it hasn't stopped. And we this is the biggest problem. We can't find buildings to buy. Tenants can't find buildings to lease. The vacancy factor is so low and there's so much competition. Rents are up 35% in the last 2 years.
Wow. Well, let's back it up for a minute before we deep dive into all the goodness about industrial and how you're going to navigate through that. Tell us, Joe, kick us off with like the question so we can get to know Joel a little bit better. And then we'll jump back into deep diving on this topic.
Yeah, Joel, we'd love to hear about your history and like where you're from and then how that led you into the real estate business that you're in today. So if you could just give us a brief overview or deep, depending on how you'd like to let us know.
Sure, yeah. So I'm from Highland Park, Illinois, which is a north suburb of Chicago, right along Lake Michigan. And I went to the University of Michigan for college, and I took some courses in real estate. And I decided I'm going to be a real estate guy. I took real estate law and I took some other courses, and I thought, wow, this is the best business in the world. So I graduated and I had no idea what kind of real estate I was going to do. Turns out that my best friend had been in a jacuzzi about a month after I graduated from Michigan. He'd been in a jacuzzi with this 63-year-old guy, which, by the way, that's how old I am now.
This story could have turned sideways, but now, once you said 63-year-old guy, all right,
we're good. Okay. We're good. Okay. And so my friend Mark calls me up and he says, I know you're looking to get into real estate. And I had this experience talking to this very, very charismatic guy who apparently owns like 80 industrial buildings and is looking to hire someone to be in the property management business. And he asked me what I did, and he tried to hire me to be a property manager, but I don't want to be in real estate. So why don't you call this guy? So I called him. His name was Milt Podolsky.
Ooh.
He had a family business, 2 sons and a daughter. I didn't know any of this. And I called him and I said, I'm looking for a job. And he said, I'm looking to hire somebody, which I already knew. He said, why don't you come in today? So I went to his office, which was in a place called Rosemont, which is right next to O'Hare Airport. And I sat with him and with his son. His son's name was Randy. And they said, why do you want to get into real estate? I said, well, I took courses in college and I love the idea of real estate. He looked at Randy and he said, what do you want to do? Randy said, let's ask questions. Randy said, are you good with details? I said, no, not really. I said, I'm good at sales. When I was a kid, I went door to door in my neighborhood and I convinced 70 homeowners to hire me to cut their lawn and landscape their yard. I was 14.
Nice.
So I ran this business and built it up. And I said, I'm really good at connecting with people and in sales. So Milt looked at Randy. He says, I'm taking him for my department. You can't have him. And Randy looked at his dad. He said, damn it, Dad, I need somebody. And Milt said, do you take no for an answer? I said, never. He said, oh, I like that. He said, you're hired. When can you start? So the next morning I showed up and Milt told me that he had 9 empty buildings. It was 1981. Interest rates were 17%.
Wow.
Companies were not moving. Nobody knew what industrial was. And he was struggling with the cost of all these vacancies. He said, I want you to do what you did with your door-to-door landscaping. Go learn the industrial parks, drive around, and fill up my buildings. So I went out and I started knocking on doors, the next door neighbor to one of his empty buildings, the across the street neighbor. And I said, hey, how would you like to move? And I didn't know what I was doing. And I got people to say, yeah, we're looking to move. Our lease is up in a year. So I helped him fill the buildings. Cold calling was just crazy. I had so many experiences. I got kicked out of places. In one case, the 2 sons of the owner of the building, I said, hey, would you guys like to move out of this dump? And they said, dump? We'll be right back. And their dad in a wheelchair comes to the front of the space where the reception desk is. They said, this is our dad and he owns this dump. He says, boys, take him out. So one son takes me under this arm and one son takes me under this arm. They pick me up, carry me out, and drop me on the parking lot. So I learned a lot about what to do and what not to do and what to say and not say. And we ended up filling up Milt's buildings. And I loved it. I loved every minute of meeting people and selling. And after 10 years of being an industrial real estate broker and making literally a couple hundred deals, I asked the Podolskys if they would adopt me so that I can be in their family business. And they laughed and said, we really don't want major partners. So I had to leave and go start my own business.
Doesn't that stink a little bit, after giving your heart and soul to that? But it's probably the best thing that ever happened to you, right? You probably would have been limited if they would have said yes.
Yeah. Right as I was thinking of leaving, I told Milt that because he was a syndicator and had millions and millions of dollars of industrial properties and dozens of investors, I said, I want to learn your side of the business. And he said, I'll teach it to you and I'll invest with you. I'll be your first investor.
Oh,
so
nice.
Yeah, I found a property. It was about a $3 million property, and Milt said, I'll put 300,000 in, you go raise the rest of the money. And we bought the property, and I became partners with Milt and his family.
And so your ability to raise that money on that first deal is that you already had a track record of leasing and you had a story that you could tell, right?
Yeah, and so I made a couple hundred leases and sales as an industrial real estate broker. And I went to the people that I had worked with as clients, helping them buy or lease a building or being their agent for leasing or selling a building. And those became my first investors, along with a bunch of people whose lawns I used to cut.
So would you recommend that, like, is that, I always talk about with people in commercials, some of the people in commercial that I know that do the best either come from the lending side initially or the broker side initially, where they get their feet wet. I'd say, maybe less the property management side, but more leasing and brokerage and, like I said, lending, where they can learn how to identify a good deal. If somebody's just getting started in whatever the asset class is in commercial, I know, industrial, what would you tell them how to get started, if they're looking to make it? Because this is a long-term biz. Like we said, this isn't, overnight. How
Yeah, I have a very serious answer to that is extremely important to me. And I'll tell you how this has affected my life since the days working for the Podolskis is get the best mentor in the world. The person who hires you is who you're going to become. So Milt was 63 and I'm 63 now, and I've become Milt. That's what happens. Find someone who's 20 or 30 years older, who doesn't need to prove anything and who's not threatened by teaching you, and learn the business. I learned from Milt's sons, from Milt himself, and another man, Richard, who was there. I had 4 mentors, and they taught me the business for 10 years. And I just want you to know, I hang on to relationships because they're very valuable to me. Steve Podolsky, the oldest son of Milt, I'm having lunch with him tomorrow here in Florida, and
Nice.
he's an investor in my most recent deal. And he was my mentor 40 years ago, and we're still together.
That's
Yeah.
fabulous. Great story. I mean, that is such a great story. So thanks for sharing that with us and inspiring everybody who's, people, the younger generation today, I feel has this immediate gratification issue. That's a little bit of a problem. And I think, reminding everybody that this entire business, whatever asset class you're in, is all about relationships. It always has been, and it always will be. And your relationships is gonna save you and take you up and let you scale and all that other stuff. Well, let's jump into some other basics about industrial. What is the difference between a Class A, Class B, and Class C industrial building?
So a Class A building, if you've driven anywhere in the United States or anywhere in the world along the tollway system and the highway system, you see these gigantic precast concrete buildings. They're painted with a nice color. Sometimes they have a stripe or they have medallions, and usually they have windows on the corners. That's where they put the offices. And then they've got a line of truck docks. Those are very tall ceilings, so you can store products high cube with forklift truck access. Those newer buildings are called A industrial. The older buildings, which are maybe from the 1960s through the early 2000s, usually smaller, sometimes brick, very different kind of construction, lower ceiling. Those are called B and C industrial. And my specialty is B and C. In Chicago, there are 17,000 industrial buildings, and the A buildings are only about 20%.
What's the difference between B and C? Is it tenant class?
Sometimes, but not always. Usually the A buildings are distribution and not manufacturing. Sometimes they're manufacturing, but I'd say that the large majority are distribution. And a lot of the B and C are actually manufacturing buildings where companies make products. We have a B build. You watch Shark Tank?
Yep.
So in year 1, there was a company that was in its first year of existence called Element Bars, and they make protein bars. The owner is Jonathan Miller, and he manufactures millions of protein bars a year. But over a 10-year period, he's grown his company from doing about 100,000 in sales, doing about 10 million in sales. And he leased one of our B buildings. So he's got about 80 people working in these manufacturing areas making protein bars. They bake the bars, they package the bars, and that's a B. He's only in 50,000 feet. So an A building wouldn't even really be big enough, or it would be too big for him. They wouldn't divide it down to the 50,000 feet. So it's mostly the size and the age.
Gotcha.
Our ceilings are only 25 feet there, and in an A building, they'd be 32 feet.
Okay, that makes sense. Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. So, you've been in the game a long time. I know that underlying business model that has saved you, or I've listened to other podcasts that you're on. I'll just ask you the question. What do you think is the key to success on your portfolio? I think I know the answer, but.
Yeah, I'm glad you checked that out. I'm going to say something that most people who are in real estate have never heard of before, which is we own our buildings all cash, no mortgages. We are extremely risk averse. Our investors have been riding with me for literally 30 years. And in 4 separate cycles, every single time that we ever had trouble, it was because of debt.
So you've had in the beginning, did you start with debt and then you learned nope, not going to do that again, or you got spanked a little bit back in 20 years ago or something?
I think I'm an idiot. Let me tell you why. In 1989, when I did my first deal with Milt, the $3 million, it was all cash. There was no mortgage. I was convinced because I had seen that Milt had lost some money and some of his investors were a little mad at him, maybe more than a little mad at him. Because it was 1981 and when I started with him and things were bad and cash flow had stopped altogether for a lot of the properties. And I said, I'm going to be the safe guy. And I did my first few deals, all cash, no mortgages. Here's what happened though. My young partner, who had never been through anything like Milt had and like I had seen, said, hey, let's borrow some money. So we borrowed a little bit in our third deal. And then we borrowed a little more in our fourth deal. We've made 95 deals, but up until 2008, we had some losses, but nothing so dramatic as what happened with the Great Recession. I forgot what my philosophy was when I was 30 years old, which was to do all cash deals, because it's like when a frog is in water and it starts getting hotter and hotter and all of a sudden it's boiling and they don't realize that they're boiling to death. I got in trouble because I had debt, which I never intended to do. It just happened. I allowed it to happen. And in 2008, I struggled. I almost had to go into bankruptcy. Instead, I fought it through. And I went into literally a clinical depression because I thought I had lost everybody's money. I had 50 buildings and I thought I had lost $200 million and that I'd be on the front page of the business news. Idiot loses his investors' money. But instead, I worked really hard in the ensuing years and brought everything back. But it was through an emotional level of turmoil like I've never had before. And I came to the Yeah, it was horrible. It was
I
really
bet.
horrible. I
What's
learned
up?
a lesson.
What takes you down? What takes are you do you have multi-tenant buildings or those single tenant buildings that what was the trouble back then where those guys weren't able to obviously I guess it was make their rent payment, which caused you to what was it in
It was
industrial?
vacant. It was vacancy.
They just went out of business or you
No. What happened was companies would have their leases come up, and they
yeah.
would just consolidate into another building that they might have someplace else, or they'd send out their products to be stored in someone else's building, and we couldn't fill them as they came empty. And so the vacancy killed us. We have a lot of single tenant buildings, and there's a very good reason for having single tenant buildings. But as I worked my way out of my depression, and literally, I'm not kidding, my wife and my parents were watching me to make sure I wasn't taking pills. I was so distraught
I
that I
bet.
could have possibly have lost people's money and been so stupid.
I think
And
my background's in commercial real estate. That's how I grew up in real estate, being not in a syndication deal, but part of a small privately held real estate investment company that has a big national footprint, a multifamily, some office, not really industrial. And when I left there in 2009, I think everybody thought that I was going to go into syndicating apartment buildings. And I just couldn't, I just had twins, girls, and I just couldn't stomach. I don't think I'm built to handle the stress of managing that other people's money that way. Right. It's just, so I, commend you for making it through uh, the storm there for sure. I was going to ask you then, so multi-tenant buildings or what's the ideal tenant mix on your properties?
so we mostly buy Class B and C single tenant buildings under 50,000 square feet. That way we don't compete with the pension funds.
Right. What's the
So
smallest size square
we
foot?
have a building in a place in Chicago called the Fulton Market, which has exploded. It's become like the hottest office and apartment market literally in the country. It used to be our meat packing area. And in 2007, I bought a 7,000 foot building there from an ink company. And today it's worth 7 times more than we paid for it. Pure luck, by the way. We didn't see the neighborhood was changing. We bought 2 buildings next to each other. In the other one, we have the U.S. Postal Service, and their rent just tripled because of the location. And we have Instacart, that's that grocery delivery company.
Yeah.
So those are our 2. So we have 2 tenants in that building and 1 tenant in the other. We like single tenant buildings because the difference between a single tenant and a multi-tenant is you can sell a single tenant building to a user, which is someone who manufactures, distributes products.
Owner occupant.
Owner occupant.
Yeah.
And they will pay a 25 or 30% premium.
Right.
It's not a financial decision for them about how much the rent is or what the cap rate is. It's they must have the building to operate their business or they can't continue to make their profit. I have a funny story about that. I've mentored about 60 brokers over the last 30 years. We had a brokerage company that I started, and I've done a lot of mentoring. And one of the things I tell my people, and I've just told someone this recently, is users who need buildings need them so badly that if you're showing them the building and they love it, and you say, I'm punching you in the face, boom, they say, thanks for the punch. Now, how much do I have to pay for the building?
Yeah. Same with single user office properties, right? It's the component of, it's kind of like on the residential side that owner occupant is going to pay more for their home, their primary residence, as opposed to a, investor who's always going to pay less. So do you attempt to stagger? How do you asset manage then? Do you attempt to stagger your lease expirations across your portfolio to mitigate having too many renewals or vacancies or TIs or any of that concessions come up all at the same time?
We do. We currently have 16 buildings, and our current loan to value ratio is 17%, and we have 3 buildings with no mortgages at all. And we stagger the leases to the extent we can. We don't dictate the lease terms. And industrial brokers control the market in every city, in every area. And when they bring in a tenant, the tenant has a need. They say, we want a 5-year term because of our projections for what we're manufacturing and how many employees we have. We can't tell them what the term is. They tell us. So it's
Maybe
kind
on
of
your renewals, are you able to control it more on your renewals? If you
no,
stagger, sort
no.
of is what it is.
Yeah, yeah. In the B and C business, we don't get very many long-term leases. We bought a building from Keebler a number of years ago. It was actually 16 years ago, and leased it to Comcast. And we told them that we wanted a 15-year lease because we were doing some internal improvements for them.
Yeah.
And they said, we're only going to do 10. I went to a corporate meeting and I sat with the real estate director and some other people running Comcast locally in Chicago. I said, I need 15 years. And they said, we'll only do 10. And I kiddingly stood up and said, well, my wife sent me here. And I have one thing I have to ask before I leave, because we can't do a 10-year lease. Will you fix my cable? Our cable's not working at our house. And a lady sitting at the table said, Mr. Friedland, we don't like it when our vendors denigrate our service. Don't mix the service with the lease. And they needed this building so badly because of where it was that I stood up and I said, if you're not going to fix my cable, I'm going to end up getting divorced and it's going to cost me more than I'm going to make on your lease. I've got to go. And I turned around and started walking out. I was just joking around. And someone chased me down and said, Joel, don't leave. We'll do 15 years and we'll fix your cable. So that's what happens in B and C. If somebody wants your building, it doesn't matter what you say or what you do, they will find a way to lease it. But it almost took walking out of a meeting to get a 15-year lease rather than a 10. So it's hard to dictate term.
So since you guys do no low debt or no debt, we'll call it no debt. How does that work with if you're buying a building, or do you do much value add? Because normally people would do some value add, do a refinance to pull the money out. Or how are you buying occupied properties, or what are you doing there?
It's a mix of occupied and vacant, and our value add is getting there first. I love brokers. I am a broker. I'm an industrial broker. I belong to the Society of Industrial and Office Realtors, which is international. I belong to the Association of Industrial Real Estate Brokers in Chicago, which has 300 members. I'm a broker. I love brokers. I want to do business with brokers, but we find our buildings by having people cold call directly, like I used to do, to find tenants. We cold call door to door and say, would you consider selling your building? Of the 95 buildings we've bought 92 of them off market by cold calling. And interestingly, of the 72 buildings that we've sold all but 5 of them to users. And most of those users were either the next door neighbor across the street or within driving distance 2 minutes. Yeah. So our value add is knowing the market. We are hyper focused. If you gave me I could draw a picture of almost every industrial park in Chicago. I could draw the lines showing where the streets are and show each building and who's in it. And having that micro knowledge is really our value add, because we know what things are worth. We know the people, and we're ready to catch the deal when the seller's ready to sell.
There you go. Focus, right?
Focus.
We call it riches in the niches. So is there a criteria? Let's say you had a industrial building. Do you need to have like X number of roll-up doors or bays per square foot, or minimum amount of power and water? And do you ever pass on buildings? What if somebody says, yeah, I'll sell, and then you get there and you take a look at the building, and is there ever anything missing that you're like, I pass on that building? Or is that
there's a lot to unpack there. The answer is yes to all of those questions. We are extreme due diligence people.
There you guys go, right? Conservative and due diligence.
Yeah. We just bought a building last year, all cash, in a neighborhood in Chicago called Sauganash. There's 11 buildings in the industrial park. I knew the owner. He had sold his business, and the business was leasing the building back from him. And he wanted to get the building out of his estate. His son and daughter were in the business, but were soon to be leaving. And he didn't want to, he's 88 years old. He didn't want to leave them with this building. So we diligenced it. We have a company that he founded called Steiner Industries. They make safety products for the welding industry. It's a 33,000 foot building. And I spent $20,000 on due diligence and spent 60 days studying everything there was to study about it. and we decided to buy it. While we were negotiating, Steiner Industries, which is owned by a company called Bunzl on the London Stock Exchange, Bunzl's broker from St. Louis, who handles all of their 70 properties around North America, called me and said, the tenant wants to renew the lease for 3 more years, and I hear you're buying it. So we renewed the lease. So we knew what we had. We knew what the lease was. We read every word of the old lease. We created a new extension for 3 years. It's an 8% cash on cash return for the investors. So the yield is 8%. We checked the roof. We checked the plumbing system. We checked everything. We checked the zoning. And until we were 100% satisfied, we didn't buy it. And then we bought it. Now, similarly, but with a different outcome, we had agreed to buy 3 buildings in a town called Harwood Heights, 46,000 feet, 18,000 feet, and 20,000 feet, occupied by a manufacturer called QCC that makes motors and pumps for tractors. We did our due diligence. I spent $40,000. I had inspections. I did environmental, and we found a zoning problem. We found out that it's not zoned right, and we walked away from the deal.
Zone right for what? For the type of business use, or?
Yes, nobody knew this. I went to all the neighbors and talked. I know all the neighbors on this street, Wilson Avenue. I went door to door to door and talked to every neighbor. I said, I discovered that this area was rezoned for retail. And when you or we have an empty building, we're not going to be able to lease it or sell it because it won't be a conforming use. I couldn't believe it. That killed the deal. So I said to the seller, we can't do this deal. I'd spent $40,000 and ready for this. I had raised all the money. Everybody had already sent their checks. It was in the Northern Trust. And I walked away and I had to send everybody their money back. Yeah.
What are the top 3, due diligence items? I mean, environmental, I would assume would be one of them.
Condition of the roof condition of the roof, condition of the HVAC. HVAC is really expensive. And I've bought for my many buildings with my investors, many HVAC systems, which are usually called rooftop units for the office. It can be $30,000, $40,000 a unit. And so we have to know what condition they're in. We have them inspected and we pay for the inspections with a trusted HVAC contractor. We have the roof checked. Our lawyer does all the title and survey work. Number 1 rule in industrial, parking. If it doesn't have enough parking, we can't accommodate tenants who are growing.
Parking for their employees?
Yeah.
Like any kind of almost all asset classes have that parking tail wagging the dog, right? Including, big thing there. So how much do you keep on reserves then for each building? And do you raise the reserves as part of your capital raise?
Yeah, we raise the reserves. I'm keeping about $5 million in reserves in Northern Trust for the 16 buildings we own. We are high on reserves. A lot of investors say, why are you holding my money? I could put this in T-bills and make money on it. And the answer is, tell you what, I'll give you all your money back. But when money is needed, you're going to have to write a check and just tell me if you want to do that or not. And nobody's said yes to that. No, just keep the money. You're right. We don't want to have to do that.
What do you guys keep the money sitting in? Do you invest it in something?
That's a really great question. I'm struggling with that right now. We get great service from our banker at the Northern Trust because we're not earning any interest on our $5 million right now.
Yeah.
It didn't matter up until just a few months ago when rates went up. It's a real big question as to where to put it as safely as possible. We have to keep it all in different accounts because the accounts are only insured up to $250,000.
Yeah, that's a problem, right? Yeah.
So we've got multiple accounts and we have to keep the cash there and be very cautious. I don't think the Northern Trust is ever going to get in trouble financially, but I owe it to the investors to do the right thing and have it invested properly.
Yeah, it's got to be a battle. So what do your syndication structures look like? I mean, how much do you take as a sponsor? That's always the question. I always wonder about that what's fair and I've had, you hear about sponsors that maybe take 20% and then they raise capital for the other 80%, or I've heard them as much as 50%. And that's a hard one to swallow a little bit. And or what's your feeling on that?
Let me give you a little bit. Let me take a few steps back. I have an internal group that have been investors with me for the whole 30 years that I've been doing this. There's 40 of us. And this group puts the money up to buy the buildings one by one, 100% all cash, no mortgage. It's a very risk averse group. And I've promised them there will be no mortgages on any buildings, period. And we buy the building with this group so we can close fast. And then after we own it, we figure out how to structure the syndication at that point based on the facts regarding that property. With the Steiner building, we bought it with that group. And then I decided really to look at what the market was, what other syndicators were doing. We have a $25,000 minimum. Most of our investors like to put in 100,000 or more. I tell people never put in more than 1% of your personal net worth. I'm not interested in having you be a genius and put all this money in one of my deals. I'm doing my best to not lose your money.
That's a good tip. Yeah.
Yeah. So if someone's got a $25 million net worth, I don't want them to put more than 250,000 in. And if it's like a young doctor who's just getting started and he's got a $2 million net worth, I tell them our minimum's 25. So you're going to be a little bit over 1%, but please don't put more than that in. And people look at me and say, you want me to put less in? Like, I want to give you more. And I say, wait for the next deal. Let's diversify a little bit.
Nice.
Because we don't have a fund. We do it deal by deal and each investor can pick. So with Steiner, we decided that it needed an 8% return for investors to be happy with it. And so we structured it. There's $230,000 a year of rent coming in. And we're into the deal for $2.7 million. Our expenses are $15,000 a year to manage it. So there's $215,000 coming to the investor group from the rent. And that's an 8% return. So I gave an 8% pref because that's what everyone should get. That's what I'm telling them. I'm not going to give them a 7 pref if it's making 8. And then we take a promote if we sell it or start making a lot more on the rent of 20% after they get their 8% cumulatively over the period of time that it's owned.
Gotcha. So you make sure they've got their 20% caught up.
They're 8%. They're 8%. Oh. They get their 8%.
Yeah.
On their money. And then after they get 8%, if we sell the building for $1 million profit, I have to make sure that they're caught up for the whole time at 8%. So if we own it for 5 years, they have to have made 40%.
Yeah. Okay. Gotcha.
And after they get that 40% on the $1 million profit, my internal partners and I make 200,000 and that investor group makes 800,000.
Gotcha. And do you have skin in the game from the beginning? And because I mean, how long does it take? At what point? You don't want to be in the property management, asset management business. I guess you kind of are, but at what point does your cash flow kick in typically on these deals as a sponsor?
Well, I'm a co-investor and so are my 40 other investors.
Yeah.
And between the 40 of us and our families, we're usually in for 25% of the deal. So for Steiner, for example, myself and my 40 people, and like I've got a partner, Nate, who's 95 years old, his daughter put 200,000 into this. Nate put $1 million into it. We're very, very deeply in with our investors, and we're very careful. We actually limit who we let into the deals. We're on this trip in Florida now, and we're meeting investors. And if there's an investor, I like people who are really good people. That's who I want to be partners with.
I hear that.
We're in this unique position where we don't need the money. We just need the right people. So we had lunch with a father and son yesterday in Fort Lauderdale, and I loved them.
Yeah.
And I said, I've got a little room left in Steiner. Why don't you go in? And they said, how much can we put in? And I said, as little as possible just to get started. They were like shocked, like, what? Nobody says that. And I said, well, we really don't need your money. We need you because we like you.
Welcome to the family.
Yeah,
do you have any
really.
buildings that are fully depreciated?
Yes, we own a building in Aurora, Illinois that I built in 1991 from scratch. Our tenant is called Feed My Starving Children. They are a Christian missionary group. They have people come in from churches and schools to pack food that they send overseas. And I've had Maytag in the building, and I've had another tenant in the building. And now the last 14 years, I've had Feed My Starving Children. So we've owned the darn thing for 32 years. So there's nothing left. And there's no depreciation left, but it's throwing off a 9% return to the investors, and they love the mission of the tenant. And these are people that the investors are people I like to go out to lunch with. So, but they know that we're not getting any depreciation. They like the cash flow. We
They
like
just
each other.
pay the bill. Do you do 1031 exchanges, or is that too hard to line up?
I've done 40 of them.
Okay.
Yeah. And we bring in people who are already investors or who we meet and who we have good chemistry with to own 50% with us. So they're a tenant in common. So my group owns half and they own half. We have one family that's got 5 buildings where they own 50% with us.
Well, great stuff. I mean, do you find that it's a less complicated asset class, than the others? And what are you going to do? What do you feel like there's opportunity coming in 2023, or are you going to be spending a lot of time in Florida?
Well, it's funny. I have 2 grandchildren and one on the way in Chicago, and my wife is there. She left Florida to go be a grandmother for a while. I have to go back. That's where we are. I have to be near my properties. I have property management and accounting being done by people who are with me for 20 years, and they're fantastic, but I have to be there.
And you guys self-manage, correct?
We do, and it's hard. Even though they're net leases, the tenants pay the insurance, the taxes, the utilities, the maintenance, but they call us when the heater stops working and we have to dive in. Yeah. And the accounting's a big thing. Investor accounting's a lot, tenant accounting's a lot, management accounting's a lot. And pipes break underground. Older buildings that were built in the 1970s, sometimes the pipe that connects the water main to the building underground, we see water bubbling up. And the tenant doesn't know what to do. So we have to handle that kind of stuff.
Yeah. So it's what type of reserves, though, do you keep on hand? Remind me again. Do you have like a percentage of annual cash flow that you try and keep on hand per building for reserves?
The minimum for an all cash deal is $100,000. I prefer to have more. I like to have roughly 1 year of rent in the bank. So if I have a 50,000 foot building where the rent is, let's say $7 a foot, 350,000 a year, I need to have 350 there.
And you raise that from the beginning?
Very beginning.
Gotcha.
Yeah.
Makes absolute sense. So what's your...
My investors like to sleep at night, and they know that I've been through some really tough times. You may have not heard this. Maybe you heard it on another podcast of mine, but I think that a lot of real estate people are gamblers. I think they're compulsive gamblers, and they get addicted to their own adrenaline.
I think it's keeping up to say they bought a building. It drives me nuts, right? It's a lot of pressure, especially for the younger people coming up. I think there's a lot of pressure, like, that you're labeled as, if you're not doing deals every year all the time, that you're not an investor. That is a bunch of BS. I agree with you there. It's tough. It shouldn't be that easy. Go ahead and preach on that one.
Yeah. I think there's a bubble right now, by the way. I think that the bubble's going to pop, even in industrial. There's no such thing as a tree that grows all the way to the sky. And we've been in a period of growth for a really long time, which means we have to be ultra careful with what we buy. Young people who are syndicators or investors can take risk, because if they screw up, if the market goes bad on them, they can start over. I'm 63. I'm not a gambler. I learned that I was one, and I'm not one anymore. And I also don't need to impress anybody. I love that Warren Buffett lives in his original house and drives a used car.
Yeah.
I'm not out to impress people. I'm out to relate to people. I like to know about their families, and I'm curious. I'm not trying to sell them anything and trying to convince them how great this is and how they're going to get a 20 IRR. It's like, hey, I'm too old for this. I'm too old. And I'm teaching my son, and I'm teaching my partner, Eric, who's 43, that it's okay to not be flashy and not be a big shot, and to buy real estate and just value the relationships with the tenants and with the investors. But when I was younger, I was one of those guys. I look back and I'm just so embarrassed that I was acting like that.
Well, you made it through. So what is your goal today? Like being on a podcast like this? You have a YouTube channel, I understand.
That's new.
Fun.
That's new.
What would is there like, are you, I know you have your investors. Do you feel like there's going to be opportunities to grow your investor base, or what can we do to connect our listeners to you? And what would that be, more for education or getting in your deals somehow, or what? And tell us
We'd like
about
to.
your YouTube channel.
Sure. My son, Sam, who's 27, has a degree in communications. He has to use it doing communications. So he went to the University of Illinois and he became an adventure travel trip leader, and took families and kids and people around to different locations around the world, the Galapagos Islands and the Grand Canyon. But he came into the business last year and he said, Dad, you've always done business with only people you know, and with all these people who are old. We need to get some younger people in and some new people in. And I've got this idea. What if we did a few podcasts and we have a YouTube and make a video? So we made a video, which cost me, literally not kidding, $30,000, and it's 2 minutes.
Really?
Yeah. We shot 4 different days, and it was almost like making a commercial, like commercial quality. But it's not that good. But it's on our website. And what we want to do is, Sam's right, we need to add people because there's attrition and we want to buy more properties in the future. We have a few deals available right now with some reserved equity for new people for a small amount. We're not looking for someone to put $500,000 in. We don't have that available.
What's a small amount? 25, 50?
50 is the minimum that most people put in. If someone's really young and new, maybe 25. If someone says, hey, I just want to get to know you, if there's someone really special, we would do 25 and hope that they do more with us. But we're hopefully, when the bubble pops, we'll be in a position to buy more properties, and we'd probably like to add somewhere in the neighborhood of 20 people a year. It's really important to us to have that pipeline to new people that we can do business with as syndication investor type of relationships.
And how does that look like? How would somebody, because you're a personal, you go for the personal relationship, how does somebody engage with you to potentially be the right fit for the family, I guess we'll say, you know what I mean? Like,
yeah. So it's interesting you asked that. We've been shocked. We've done a few of these podcasts and we've done our video and we're sending emails. We hired a company called Sapper out of St. Louis, and they send out emails to thousands of people that are really cute emails. We've actually gotten 3 investors from that. And the first family put $250,000 in. The next one, we tried to take less and they did $100,000. And the third one did $50,000.
Yeah.
Those are the increments that we're talking about. And the way that people can learn about us is we have a website. It's BRIT, B-R-I-T Properties. And we have our offerings there. We have our videos there. Articles. We have an article called Why You Shouldn't Invest with Us. And I recommend that everybody reads that because it's all the things that, if I could tell my mother what to ask a syndicator before she invests, the questions are in that article.
I love it.
So we're very different. We're not out there trying to build the biggest thing in the world. We're trying to create something that's super safe for a really great group of people. I want our investors.
What's the name of your YouTube channel?
I don't know. I think it's just Brit Properties YouTube channel.
Make sure you send it over to Joe and we'll drop it down here in the show notes.
That'll be great.
That in the article, we'll make sure that people can get a little bit more deeper down the funnel with you guys there. Well, this is good stuff. Definitely appreciate your time today. Do you think there's going to be some opportunities? Are people going to fail in 2023 on these buildings? Yeah.
Interest rates are really important to businesses. It's their lifeblood. And a lot of businesses with too much debt will not be able to refinance their debt, and they're going to have to sell assets. That may be a sale leaseback opportunity where we can give them some cash for their building and then lease it back to them.
Do you do that often?
We do that probably. It's funny. Every fourth deal, we usually end up flipping to somebody in the area before we even syndicate it.
Oh, really?
We get there and then we call the neighbors up and down the street, and someone says, how did you find that building? I would have bought it. How do I buy it? What do I do? And so we flip to people because we get there first.
What does that mean? You assign your contract?
Yes. We assigned a contract recently to a company in the pork packing business, 6 acres that we bought from the gas company in the city of Chicago. And he bought the property and he's building a $30 million pork processing facility. And he's become a friend of mine, and he invested in in the Steiner building. It's like it's really. Oh, in our element.
You have people that ever sell it? You buy their building, you give them their proceeds. They're on their way out. They're older. They're whatever, and then they become your investor.
No, usually if they want to get out, they want to get out. Gotcha. It's never happened. We've asked multiple times. Nobody wants that.
Yeah.
If they're getting rid of the asset, they want to get rid of the asset. They don't want to be part of the group.
Good stuff. I think we'll wrap it up for today. Is there anything else you want to add before we sign off?
No, I think you've asked really good questions. Well, this is the most in-depth interview that I've ever had, with more detail than I've ever given.
Oh, that's our specialty here.
I hope we don't bore people with all this specific stuff.
I think people are used to me, on the deep dives, and that's why they like to listen, because it's goes deeper than just the overview of the fluff. I mean, they actually get to learn something here, right? I'm excited to look at your YouTube channel and read some of these articles myself. You might find me signing up to be one of your investors here.
Well, that would be great.
Yeah, I know.
By the way, one quick last thing. Nobody invests with us over the internet. We have to talk to them and get to know them. I need to know about their family. I need to know about their business. I need to know about their philosophy. Someone can sign up to have a call with us or a meeting with us, and that's a really important thing for us and for them. Yeah. And usually they want to talk to existing investors of ours, and we'll give them names and numbers of existing investors who are happy to talk to them.
What I like about you guys is it sounds like you protect people from themselves as well.
Yeah, I think people get into an emotional elevation state and they make stupid decisions. It's like when you're listening to your favorite song and you're really rocking. Like, you might make a decision because you're feeling really good, and you might regret that decision later, or it might have consequences. Yeah. I think people sometimes, just because of what's going on in their life, they have an elevated mood and they're not thinking clearly, and they're not analyzing, and they're not curious enough. I have one guy that said, "Hey, I trust you. I'll just put the money in." And that's okay, but I don't really think that that's great. So I am sometimes protecting people from themselves. Definitely.
Good stuff. Well, all right, Joseph, where can everybody find the details about today's podcast?
Yeah, guys, this has been great. And you can find all the details, and I'll dig up those links from Joel, so you can find those as well down in the description below if you're watching on YouTube. And if you're on the website, or I should say the website URL is seattleinvestorsclub.com/176. And the notes and the links will all be there as well.
Awesome, guys. And of course, we don't ask very often, but if you enjoy the content, please subscribe to the channel here, or hit the whatever people say, hit the notification bell. I don't know. I feel like I hear other people say that, so I'm supposed to say it. So there you go, Joel. You're supposed to say that on your YouTube videos, I guess. So do that, guys, please. We appreciate the feedback, and make some comments if you're enjoying our content. And we will see you on the next one.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.